Every trader needs an exit strategy thought out before they actually enter on their trading setups. For day traders, even a exit before market close, while being basic, it still has you with a plan for ending the trade. Without a trading exit being part of your overall trading strategy, you're just leaving yourself up to issues including using your emotions as a reason to exit. So let's remember that there are at least two exits that you should be concerned with. Where to exit a trade that's in profit, which is your profit target, and where to exit your position if the trade is not giving you positive feedback, which is your stop loss location. So knowing these two locations can help ensure that you do not blow your trading account due to a few emotion-filled trading exits. But you also want to keep in mind the type of trader that you are. Day traders may not allow much, if any, retrace against their profitable trades. A swing trader, they just might give the market more room to breathe. And position traders must be comfortable with a trade that goes 20% against them. Now, setups are talked about a lot in forums and in personal conversations I have with traders as if they are the deciding factor in your success. And what's interesting, while retail traders look for the perfect entry, those that are at the top of their game, those in the success stories that you're reading about, they say that the entry is the least important part of their trading plan. What we don't hear enough about is where you're going to exit your trade, either with a profit or a loss. Now, everyone has their own take, but I believe it is the exits that are the most important part of your trade. How you manage your exits will be the deciding factor on your potential for trading success. Without a defined exit, your loss will quickly become painful to your account. And on the flip side, when do you bank your profits? To plan your exit, a trading rule is something that you must master and implement. And the only way to define your initial risk is to have a point where you will exit from the trade. So if you think of yourself as a risk manager instead of a trader like I do, it's a dereliction of your duty to not know where you're going to exit. Now, losing trades are a part of trading that we're all going to have to learn to live with. And they come randomly, as do your wins, and you never know if the next trade is going to be a losing trade. And because we operate on the random distribution of wins and losses, our exits to preserve our trading accounts from losing trades are crucial. And I want to cover this with the understanding that I'm talking about trades that may briefly go in your direction, but never showed actual determination. These are the trades that never went far enough into profit to even partially scale out. And the textbooks are going to tell us to use support and resistance levels. And while that makes sense from a theoretical point of view, the reality is this could be a problem. And the biggest problem is knowing if the levels that you choose are any better than the random levels on a chart. Now, I'm not going to dig too deep here, but here's a simple test that you can do. You can just turn off all the price bars on your chart, place random lines on your chart, turn the bars back on, and you're going to notice these random lines seemingly support and resist price. And some are even going to act as both support and resistance. What makes a line an actual level is a process of discretion, which is why I prefer a more mechanical way of placing stops. Using the ATR, the average true range, it takes into account the market volatility over a set time period. It's factual, it's not up for debate, and it requires no subjectivity. This here is the daily chart of crude oil, and I've highlighted just two areas as an example. So let's say you enter the first trade due to the momentum move that wiped out the previous 10 days, and you want to get into a potential move lower. So you position in the break of the small range, and in your consideration of stop placement, you consider the top of the basing, which is where most people are going to place their stop anyway. But how far above it will you place it? That's some subjectivity right there. You consider the average true range of $1.91, and you choose 2x ATR stop for a $3.82 stop from your entry. Either way, they're not touched here, but one is a guessing game that is going to be hard to be consistent with. Which one uses the actual volatility of the market and keeps your stop away from the normal daily market range, and you can consistently replicate for a systematic approach that is easily repeatable across all asset classes? That uses market data. The ATR trade exit strategy makes more sense. And it's also a lot easier to backtest when you consider your entire trading strategy approach. And that is my top pick for a stop loss. Profitable trades. While letting losers run and cutting profits short are what a lot of traders do for a variety of reasons, including emotional reasons, fear, greed, and having no trading plan. Now, our trade exit strategies must include a systematic way of taking profits, paying ourselves for the work of working our trading plan. And one of the main reasons for the premature trading exit is that traders have no concrete way of determining if the trend is ending. On top of that, what trend are we talking about? On any chart, there's not simply one trend, as the trend intraday may be opposite to that on the daily chart. It all depends on what your trading goals are. Maybe you don't consider exiting when the trend ends because you set profit targets, as many day traders do. And there are many choices for you to do that, but I'm going to cut it down to 3 main ways for swing traders or even day traders to exit your profitable trades in a way that is repeatable. Now, consistency is really understated in trading. You can look for a parabolic move in the trend direction. You can look for a failure test of a previous high or low. Use a trading indicator like the Keltner channel and look for price that stretches away from the moving average. So parabolic moves. A sudden rush of buying or selling can indicate fear or greed, and these extremes generally result in a snap back of price. But the issue here is, what are you using to quantify a parabolic move? So while eyeballing the bars that are extreme in size compared to surrounding bars is a choice, can you repeat it consistently? Maybe consider using a short-term ATR such as a 2-period setting, and if we are seeing a X% increase, you'd exit the trade. This is something you're going to have to work out in your back testing, but notice the suggestion, it's not up for subjectivity. The move is either X% more than the previous ATR reading, showing a market volatility increase, or it's not. The failure test. This is where price tests a previous and significant high-low, and when there's no participation, traders play the opposite move. Well, this is also subjective because you're going to have to determine a few things. How do you determine a significant high? How far does that high have to be breached before you consider an actual test of the high and not just noise? And what do you do if price, after breaking the lows of the first 3-bar sequence here, does not return to the high? This is a good example, in theory, of using price action as your strategy. But again, discretion is at play, which makes it difficult to test. And it could also cause you to be inconsistent unless you have strict rules in regards to what I just talked about. Now, what about Keltners? Well, with the Keltner channel, we do have an objective and consistent measure of extreme moves, especially if price breaks the upper or lower band. So let's say you trade the bull flag that's shown with the red line and you went long on the break where the green arrow was pointing. So a Keltner is going to expand or contract depending on volatility, not as wild as a Bollinger Band though. And when price hits or exits the band, do you need a close or a break? Is that okay? Well, you close the trade. So the issue is that price can run up on the upper band, and in this case, on the right side of the chart, that's a large price move that you would have missed. So do you put in a rule that the break and the pullback to the midline is needed for the exit? So again, like the extreme price move and the failure test, these trading exits must be tested and monitored. The more complex you make the rules, the more you risk being inconsistent and ineffective. Well, trailing stops. So here we come to something that I personally prefer because I don't think that I can predict with any degree of accuracy where the best trading exit is going to be. And I also think of letting profits run. And if I want to make the highest returns, trailing my stop is the most effective and consistent way of doing that. So a trailing stop is just setting your initial stop loss, and as price moves in your favor, you trail the stop up or down if you're short to let the trade ride. You don't move the stop further from price once set, so keep that in mind. Trading in the direction of the overall trend with a simple entry strategy while using the ATR, it keeps you in the biggest move on this chart. So the question you need to ask is, what is the multiple of the ATR in your testing and in your comfort level, and which one is showing you to be best? Using a 1x ATR keeps you in until the market makes an average adverse move against you. 3 times the ATR will allow news to hit the market and probably keep your position safe until a change of market state actually happens. So some of you can handle a trade and drawdown while others want to bail at the first sign of trouble. So regardless of which one you are, the ATR allows you an objective and consistent way to stay in trades that are true to the market volatility. Well, what about risk reward? And I'm sure some of you are worried that you can't measure the risk reward by using a trailing stop. Well, you can't really measure reward. It's unknown. But you can measure risk, which is more vital than the reward if all things are equal. Reward ratios are best guesses, and there are no guarantees you will ever reach a 1-to-3 risk reward on any trade. And the longer you shoot for reward, the more chance you'll see your profit evaporate at 2 times your risk, for example. So if you keep your stop loss in the same location as price advances to your target, you run the risk of losing it all. While you were initially risking $1 to make $4, you're now risking $4 to make the extra buck. Risk reward makes for some really great writing, but in trading, it's not as practical as many make it seem. In order for it to make any sense, you're going to have to be able to predict where price will stop. Believe that your resistance or your support zones that you're targeting actually means something in the market. And be comfortable risking all you've gained in a trade to get your magical reward ratio. Now, limiting your risk, it's vital for your chance of success. And you must be able to accept the following if you have any hope of achieving any level of success that you want. You can control your trade entry. You can control your exits. You can control your risk via your stop loss. Everything else is out of your hands. And if we accept those as true, it makes sense to focus on what we can control to the best of our ability. Once you place a trade, the market is going to do whatever it will do. That's a certainty. And it makes sense to let your trades run. And this must be done in the context of a complete and tested trading plan.